Hello, everyone. Happy Friday. Welcome to the final bar. Today, we wrap the week. We focus on how the markets have evolved from last Friday to this Friday. We have plenty to talk about. Nice rally going into the close yesterday, really continued through the course of the day. Today, brief pullback in the afternoon, but finishing toward the highs of the day. The S&P closing back above 4,000. The question a lot of people wondering, was that it? Was that the bottom? Have we seen it and witnessed it? I don't think so, and I'll show you the evidence why. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis, using the StockCharts platform to better understand what's happening around us as investors, better measure the key inputs of price, breadth, and sentiment. What can they tell us about market conditions and how they're evolving? I will tell you, in any environment, charts can be very helpful in helping you to understand what's happening, understand market dynamics, and respect the lessons of market history. But no better time than the present, right? When you see a market that has clearly changed from last year to this year. Year to date, 2022 has felt very different. I'm thinking of my conversations with some of my guests this week, like Matt Maley and Larry Berman, John Gagliardi. We talked about sort of the rotation. That was sort of a consistent theme, is transition from the bull market phase to bear market phase, from accumulation to distribution. You have bounces like you saw today, and I would argue this is still bear market rally type of feel. Bear market rallies like this, sudden moves off of new lows, can be super sudden, super severe, and super seductive. But we'll talk about what the long-term trends are still doing and what to be looking for to really maybe better evaluate a rotation to the upside. We have great guests on this show. Again, I mentioned some of the ones from this week, which were a lot of fun, some really good conversations. I'd encourage you to go back to stockchartstv.com to review any of those interviews from this week if you missed them. Next week, three good ones. Tuesday, the 17th, we have Ari Wald from Oppenheimer in New York. On Wednesday, the 18th, Mark Chaikin, legendary technical analyst, creator of a number of technical indicators we refer to on this show. They're joining us on Wednesday. On Thursday, the 19th, Louis Yanis from WealthNet Investments, coming to us from Colorado. Also want to mention my upcoming webinar. Next Tuesday, the 17th, 1 o'clock Eastern, I'll be presenting a special webinar for free called 7 Habits of Successful Investors. We will loosely take Stephen Covey's 7 habits and adapt them to the investment process. What are 7 habits that I've seen top investors and money managers demonstrate in their investment process? How can you emulate those in your own? You can sign up at marketmisbehavior.com/7 habits for that free event coming up next Tuesday. Let's continue on today's show and talk about this market. We'll review called the Wrap the Week segment every Friday. Let's take a look back at the last 5 trading days. What's really changed? What techniques and what lessons can we learn? First, though, I want to start off with a poll that we asked you recently. We always have a poll going on our Stock Charts live stream page at StockCharts.com, also on social media. So give us a follow on Twitter. Check out our channel called Stock Charts on YouTube. We asked you recently, how important is sentiment in your process? That's things like the AAII survey, the Name Exposure Index, both of which we talked about on yesterday's show. 19% of you said very important, 47% somewhat important, 22% not very important, 12% of you I'm a little worried about. Now, is it the most important thing in your toolkit? Not for me, and for some of you, certainly seems to be fairly significant. I think of it as the third in line after price and breadth. Number 1 is price. What is the market doing? Number 2 is breadth. What can I learn about the individual stocks that make up those major indexes? But then a third very important piece is sentiment. What can you glean from sentiment data, from positioning data, from survey data, to help you better understand what is happening inside the heads of other investors? So if you answered not very important, or I literally never look at those things, check out some of our sentiment data on our chart school pages, because I think you could find that some of the movements in the market make a little more sense if you dig into sentiment a little more deeply. Let's continue to wrap this week. We'll look quickly here at how the markets shook out on Friday today, because basically you had a big move to the upside in a lot of the risk assets. And then we'll look elsewhere at some of the other lessons we can draw down. S&P up over 2% today. The Nasdaq really leading the way higher, finishing today almost 4% above levels yesterday. Now, that's interesting in both cases because that bounce off of the new swing lows. The S&P closing back above 4,000. 4,000 is that 50% level. If you take September 2020 to the high in January 2022, it's about 50% of the way down. And so a key level to see if it's able to hold. Closing and remaining below that level is sort of important to the continued bear case, because it shows we're unable to regain resistance. This bounce is an interesting one going into the weekend, a little bit of renewed optimism. Let's see what happens next week. See if we get a renewed move to the downside. Now, mid caps and small caps, all three of those, by the way, large, mid, and small, all up about the same amount. So no real clear story, I would say there. The VIX is back below 30, which is actually a really interesting one. We've seen volatility push to the upside, the VIX getting above 30 and spending most of the last couple of weeks above that key level, coming off a little bit today. Elsewhere, big moves higher in consumer discretionary and energy and technology. All three of those sectors up 3%. The worst performing sectors were still up over 1% today. Healthcare and utilities at the bottom of the list, followed by industrial. So overall, certainly a move back to short-term strength here. And you look at some of the bounces that you saw in gambling stocks and renewable energy equipment, cruise lines, all bouncing up, 10, 12, 15%. But again, the concern I have is these are coming off of new lows just in the last week. So it's not like these are ripping to the upside. They're bouncing off of very, very depressed levels. Now, let's talk about what we call the wrap the week chart. This is just looking at the weekly returns. Now that we've talked about what happened today was sort of a move back to risk on. You had cryptos bouncing to the upside as well. How did the last 5 trading days actually go? We'll start with the major asset classes. In black, we have the S&P 500, finished the week down about 2.4%. Very, very close to that, a cluster of different indications. The Nasdaq was almost identical returns to the S&P and really closed the gap here, in today's session by leading the way higher. You also have in purple, this is the Russell 2000 small cap. So all three of those right about the same, down about 2.4% for the week. The only thing that underperformed in this first group is gold. The GLD was down 3.8%. Other things all outperformed the S&P this week. In brown and in orange, we have emerging markets and crude oil, both down about 1% for the week. What was up in the green for the week? First, we start with the green back the dollar, which was up 0.9%. In red, the best performer, bond price is up 2%. Interesting. I think it was yesterday, Matt Maley was talking about that mean reversion. Dollar had been strong. Maybe it comes off. Bond prices have been weak. Maybe we get a rally there. And this week so far sort of playing out with some of those trends that he was alluding to. We add Bitcoin into the mix, and you can see how painful it's been in crypto land this week. So Bitcoin from last Friday's close off about 17% up from those levels. And, we've talked about big round numbers on cryptocurrencies. Bitcoin, Ether recently really trading around some of those big round numbers, potential support and resistance, and seeing if Bitcoin's able to build on this bounce that we saw going into today's equity close is a really interesting thing to evaluate over the course of this coming weekend. Let's finish off our Wrap the Week segment looking at the Mindful Investor live chart list. So this is a list of charts that I keep updated on StockCharts.com. If you've not seen our Friday episodes before, if you go to the articles tab at the top of StockCharts, go to my page, which is called the Mindful Investor. You will see a list at the top, a link to this list of charts. I keep them updated. And at the very least, every Friday, I'll get them ready for the show and make sure that they're reflecting what's going on right now. So big change today on Friday's close. My long-term trend model finally turning bearish. My long-term model has been bullish since June of 2020, while my medium-term model, which is really my main measure of risk on and risk off, that turned negative the beginning of this year. It turned slightly positive for a couple of weeks there in March, but then renewed in April. The downtrend, basically telling me to spend most of this year in risk off mode. The short-term model has been negative for much of this year as well. The long-term model has remained positive. Now, it doesn't turn negative very often. And if you look back in time, when it does finally turn negative, if you look in 2018, it actually gave a sell signal about a week before the eventual low there. In March of 2020, it finally gave a sell signal at the lows. The low week was when it finally turned negative, because what happens is in more drawn out, more secular bear market phases, you will see that model turn negative. and remain negative for an extended period of time. That's what happened sort of in 2001, 2002, back in 2008, 2009. Some of those longer, more drawn out corrective periods. The long-term model ends up being pretty meaningful, but it's really designed to capture more of those real bombed out markets, and particularly when we transition into more of a secular bear market environment. So just turning negative this week, certainly an important thing to watch. For me, the main measure is a medium-term model, which has been negative now for the fourth straight week, reaffirmed on today's close. The daily chart of the S&P shows this bounce. And again, the reason why I'm not gushing all over about how exciting this is that the market's ripping to the upside is because we haven't done enough yet, I think, for the market to really deserve this. This is one strong day. But if you look at the last 6 weeks, we've seen a number of big up days in the face of this downtrend. Most notably was back here in late April, early May, where we broke down to 4,200 and then just these big, huge moves back up to 4,300 before rotating lower. And so I think, a big bounce on a day like today is important. That's great. To really, and as a tradable bounce, it certainly suggests that there are people coming in, there are investors coming in and buying in on short-term weakness and even the building long-term weakness that is absolutely not to be minimized. However, a trend is not just one day, it's a series of days that really materialize. So seeing if we can put in a higher low, can we regain the highs? And I think the challenge for this market, you have to get up pretty high on the S&P to make a new swing high. I would argue all the way back up to 4,300. That's another 250, 270 points above the current level. So while today's bounce is interesting, while we're overdue certainly for a bounce to the upside, regardless of what the long-term trend is, I would be keying in on some of those previous highs. The mark of a downtrend is you attempt to make new swing highs and you fail. We saw that here in late March. We saw that here in late April, early May. The question is, do we see it? Do we see it here? And again, if you ask me to pick, I would probably say that's what we most likely see. We're due for a short-term bounce. Totally fair. I would probably be thinking that as more of a mean reversion exercise, more of a bounce to alleviate some of these oversold conditions. That unfortunately will set the stage for further price deterioration. That's when you key on key support levels. Now, breadth has been giving us plenty of signals that the conditions are not ideal. When we look at the cumulative advanced decline lines, now these are not updated for Friday's close just yet. We're still processing the closing data and making sure we have this updated. But if you look at the data up through today's open, you essentially see that 3 of these 4 advanced decline lines have made new lows for the year just in the last week, right? They've undercut their March lows. The only one that is not is the S&P advanced decline line, which is holding support. So if you're looking for a bounce, this is kind of the time when that would make a ton of sense using this measure of breadth. What would suggest to me that the bounce is over and we're now rotating lower? Well, this sort of breadth line makes a new swing low, along with the ones that have already occurred in some of those other cap tiers. We talked about this chart, I think, on yesterday's show, or certainly earlier this week. The percent of stocks above their 50-day moving average down to 17%. Stocks above their 200-day down to 30%. These are fairly bombed out breadth conditions if you compare now to the last couple of years. But if you go back over the last 15, 20 years, you can see that when the market really enters more of an extended bear market phase, I'm thinking of like 2008, 2009, these indicators get that low and even go much lower in really negative markets. Both of these indicators, and particularly the bottom one, the percent above their 50 days, should get all the way down to 0, which tells you everything's going down. People are still buying things like energy stocks and staples and other things that are making new highs. For people to go full risk off, those things go lower, and you start to see these indicators go even further to the downside. So that is our Wrap the Week segment. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate joining us every weekday after the close. We have a lot of great plans to improve this show over the course of over the year and in future years. So certainly welcome your feedback. But we mainly are interested in hearing from you for your questions. We're going to do a mailbag segment a little later in today's show. We'd love to feature one of your questions live on the air. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, via YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions, hope to answer one of yours live on the air on our next mailbag segment, which will be Tuesday of next week. Also, go to StockChartsTV.com. That is our on-demand platform. You can see so much great content from all of our previous guests, expert commentary from knowledgeable experts like John Murphy, Martin Pring, Larry Williams, and others, and also special events like The Pitch, our Market Outlook series, our mid-year update, which will be coming here in the next couple months. All of that for free at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. Let's continue on with our next segment, which is called Power Up. What we like to do with some regularity is revisit some of the functionality on the StockCharts platform and help you understand how to use our platform even better to understand the markets and what's happening around you. We're going to go on the StockCharts website to the top bar here, and I would encourage you to go to where it says Charts and Tools. We have a lot of great functionality, some things that I think many of you use very regularly, other features and components that you probably have not spent a lot of time with. And where I want to focus right now is what's called our sector PerfChart. The PerfChart stands for performance charts. We have a whole engine which is just designed to help you understand performance of different asset classes over time. If you click on sector PerfChart, this is going to show you where we're at. I just want to talk to you very briefly about what we're looking at here and how you can use it to better understand the conditions that are happening around you as an investor. This is preloaded with the 11 S&P sectors using their ETFs and the S&P 500 as a benchmark in the far left. And you can see with the color-coded labels here and with the text at the bottom which sectors we're representing here. So far, year to date, if I click that off, I'm looking at the 11 S&P sectors and where they are at for their returns through the course of the year. If I click on the S&P 500, all of a sudden it's doing relative performance. So it's basically taking the S&P 500 as the zero line and showing me each of these different ETFs and how they are performing on a relative basis. If the S&P's returns are zero, how well have these sectors done above or below? And what's interesting, we're starting with 200 days, which is kind of an arbitrary time frame to start with, but I can't help but notice how energy has outperformed 72% over the last 200 days. That's crazy. We can switch to year to date. So all I did was I right-click down on the time frame. You can, use the mouse to bring in different timeframes if you want. You can even move things around and see how things have fluctuated. I usually don't do much of that. I usually right-click and pick one of these pre-canned items. So if you look, as you right-click and switch a different item, we get a different time frame that we're reviewing. I'm doing year to date, which as of yesterday is 92 days. And now I can see that energy has outperformed the S&P 500 year to date by 60%, by 59.6%. Half of the sectors have outperformed the S&P, and in order, after energy, we have utilities and staples, which are both outperforming about 16 to 17%. We then have a step down to a couple others, healthcare and materials, both outperforming by 7.5 to 8%. You then get down to industrials, financials, then you have the FANG sectors over here on the far left side, discretionary communication services and technology, which are all underperforming year to date. If you want to think about a particular time frame, if you want to think about how this market has changed and where the opportunities have been, this is a really good place to sort of start that analysis. What's also interesting is if you go below there, we have a sector rotation model. This is driven by the expertise of Sam Stovall. He wrote a book a number of years ago talking about traditional sector leadership and laggardship in different parts of the business cycle. So what sectors tend to do well as the market's in a bull market phase? What tends to do well as the market's topping out? And if you look at some of the leadership in orange, we have the idealized market cycle, late cycle leadership. As the market's starting to roll over, you tend to get leadership by materials and energy, then into consumer staples, healthcare, and utilities. What three sectors are we probably talking about the most in terms of emerging relative strength? It's those three: staples, healthcare, and utilities. So it's sort of in some ways following that playbook very well. We're going to wrap this segment, but just want to also remind you in the upper right, you can click on a number of different predefined groups to make sense of relative returns over different timeframes. Our next segment is the Final Bar Mailbag. As a reminder, we welcome your questions at all times. The Final Bar at StockCharts.com is our email. And let's get to question number one. When or how do you read such a chart to take action? It has no value to a trader to see that 3 months ago, energy started ascending above the SPY. There seems to be a world of difference between some CMT guy, I love this, talking about past charts, and someone that has to trade and hopefully show a profit. And what I love about your question, you certainly have an honesty to your question. I will say, number one, it's not just CMT guys. We have some fantastic women CMTs who have done exceptionally good work. Katie Stockton was just on the show last week. So it's not just guys doing it for sure. I would also say that, but you're right. Part of my career has been spent in this sort of role where I'm not an institutional investor. I'm trying to help people invest better and make better decisions. But I've also spent time in a money management operation where our goal has been to outperform benchmarks and actually manage returns. And so there is definitely a difference between talking about charts and using charts. Now, given the ethical restrictions we all agree to operate on when you're a CMT guy like I am, is you agree that you're not going to make recommendations to someone who's not a client, and you have a series of ethical standards that you aspire to. That's why I think the CMT is so important. It's like the CFA and other professional designations. We've all agreed to follow a certain set of ethical standards. So I'm not making any recommendation with any of my observations. However, what we try to imply is how you can use the tools and visualizations we're talking about to make better decisions. If you're looking at this chart and saying there's no value in the fact that energy's gone up a lot, or there's no value in seeing the semiconductors have gone down a lot, I would say you're missing the benefit of trend following. The whole reason why we talk about these charts and what's working and what's not is if you look at a certain time frame, particularly like that 3 to 6 month time frame, a ton of research over many decades and many cycles has shown that your best opportunity on that time frame is to buy strength and sell weakness, to buy, to follow trends that are continuing to the upside, to get away from trends that are going to the downside. And you'll miss things when there's a transition, when there's an inflection point, but overall you'll benefit on the fact that markets tend to trend. The data actually supports that. Now, if you're more of a swing trader, which I think you're implying, more of a short-term trader, I think this helps you understand the environment that you're operating in. It's good to know that energy is fairly extended after having a pretty good run, and recognizing the pullback in stocks like Valero and DVN most likely are good to be bought because they're still in long-term trends. I think that is the piece of this that could add value to you as a short-term trader. I always tell people, start macro, go micro, start big picture, go small picture, go long-term to short-term. So if you're a trader and you're missing this long-term form of analysis, I think you're missing one of the great advantages to understand what's happening in the markets. Next question. You had some of my favorites on the show recently, Katie, Mark, and Larry. I think you're talking about Katie Stockton, Mark Newton, probably, and Larry Berman. While I love their presentations, I struggled to decipher a common message. It seems that Katie and Mark are warning to be cautious until June/July, S&P around 3,800. I think that's right. While Larry nudged to buy in May and make some hay. What's your take on this? What data points lead to this variety of opinion? It's funny, and I found early in my career, one of my least favorite questions was, what do the charts say about gold? What do the charts say about the euro? And there was this implication by that question that the charts are obviously telling you all the same thing to everybody, and you just have to learn how to read them. Within the technical community, one of the things I've always loved to do is talk to my peers in the industry and see who's thinking what. And it is very rare that we're all in agreement, even though we have learned the same toolkit. Our timeframes may be different, our universe may be different, our just the way we're trying to approach this game, just growth investing versus value investing, trend following versus mean reversion. Those are very different ways to use the technical toolkit. So it's reasonable to expect that our opinions are going to be different. And I would love to say that sometimes, that the market usually is very straightforward and very clear. Looking back, we've been talking about the market's distribution, really starting in November, December, January. So the market's making new high, and it wasn't confirmed by so many other things. We started talking about that divergence. And I think that, was one of those times when things feel fairly straightforward. The fact that the market's gone down as it has makes a ton of sense. But where do we find a bottom? You will find a great amount of disagreement among me and my peers in the industry. So I would say they are all looking at different particular inputs. Katie, for example, just made some noise earlier this week. I think it was this morning or yesterday morning, because one of the DeMark indicators she follows had an exhaustion signal, which signals a bit of a potential upside bounce. Not really confirmed yet from other things, but starting to emerge. The three analysts you mentioned and myself as well, we actually have different toolkits. There's some overlap for sure, but in the end, we're looking at different charts. And again, that's why I love having people like that on my show, because I get to ask them some questions about what they're seeing and what data points led to their variety of opinions. That's my long-winded answer to a very thoughtful question, and thanks for that. Next question, is it correct to interpret this as a head and shoulders pattern given the long time frame? If so, how would a measured move be calculated and what points would be used for its projection? And this is the chart that you sent me. Again, when you send a chart in, particularly if you email it in, put the permalink. So below Sharp Charts or in ACP, you have the ability to send a permalink. What that does is it gives me a hyperlink. I can actually look at the live chart that you were looking at on your login. It's a great way to put a visual to your question if you have something you'd like to ask about. So is this a head and shoulders top? I'd have to say no, and I'll tell you why. Part of it is the time frame. So if you look at some of the classic books, like John Murphy's book, I forget how much Martin Prink talks particularly about the time frame, but I know the Edwards and McGee book, which a lot of people call sort of the Bible of technical analysis, talks a lot about support, resistance, and price patterns, price behavior. Talks about sort of the idealized time frame. The head and shoulders pattern is really like a couple months to a year is sort of the general way I would summarize that pattern. And people have found them in shorter timeframes and in longer timeframes, but that was really the way the pattern was created. That's how it was identified and really popularized with that sort of time frame. The real problem I have with this, though, is for it to really be a head and shoulders pattern, you're missing the fact that there would be a big run up going into the head and shoulders pattern. If I draw even more data in here, I'm betting that's probably not the case. Yeah. So if you look, this isn't, this is too broad of a pattern. I see this more as a big range bound pattern than a head and shoulders pattern. The other thing you're missing is, remember, if you're doing a head and shoulders pattern, and again, I don't think this is a great example of that. If you want to do it right, you actually have to use the neckline. So that's the lows between the head and the two shoulders. So the neckline's actually all the way down there. You would have to technically break down through that level to confirm that as a head and shoulders pattern. A lot of people sort of fudge the neckline, and it's sort of a wishful thinking sort of look at it. While you can think about support and resistance for other reasons, no, I do not think this is a head and shoulders pattern because of the long-term time frame, because of the neckline that's not really very well defined, and also by the fact that just the pattern takes up too much of the chart. It should be a shorter time frame relative to the trend you're looking at up until that pattern. We need to wrap this show, folks. Go to the 3 and 3. Let's go through 3 charts in just under 3 minutes that tell the story of this market environment. Here's chart number 1. We're looking at the Nasdaq Composite. Got a big move higher today. Big close higher yesterday, and then a move back to the upside today, pushing above the 50% retracement level. The 50% retracement level on the Nasdaq Composite is taking the March 2020 low, the November 2021 high. You can see 38.2% of the way down was right around 12,500. Look at how well that was pegged there in February and March. We broke through that, which means we're down to the 50% level. We closed below there for 2 days. We're now bouncing back up. If we get a confirmed close below there, I would see downside to the next Fibonacci level, which is around 10,300. That would take us down to the lower end of that congestion range from September, October of 2020. Chart number 2 is looking at the S&P 500 bullish percent index. This is a breadth indicator. We didn't get to it in our wrap the week segment, but it got below 30% this week. It actually got right back above 30% on the close today. So certainly something to watch going into next week. But if you look on the bottom, here's the S&P 500 on a closing basis going back to 2007, and you can see when the indicator has gotten below 30%. And this essentially lines up with all the major bottoms that we've seen going back in deeper history. Here's the problem. The first time that this indicator went below 30% in 2008 was in January. From there, you actually had another year plus of a downtrend before the bottom was actually put in place. So that's when people say that's the buy signal because look at where it's bottomed out. You're missing the fact that longer corrections can actually cause these indicators to remain in sort of an oversold or overextended condition for quite some time. So I'd be watching that chart for sure. Finally, our third chart is AMD, Advanced Micro Devices. I was chatting earlier today with the folks at Forex Analytics, Dale Pinkert and Blake Morrow and others. Had a great discussion with them on their webcast. We talked about semiconductors. Nice bounce with AMD up almost 10%. But again, I would love to see a higher swing high. Can that stock get back above 100? Folks, that is a wrap for this show and a wrap for this week. I want to thank you so much for joining us every weekday after the close for the final bar. All of our previous interviews and episodes are at StockChartsTV.com. Go Bruins. Good luck in Game 7 tomorrow. For StockCharts.com, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.